On November 6, 2022, FTX was the second largest cryptocurrency exchange on the planet. By the end of the week, it was bankrupt, missing $8 billion and leaving nearly 2 million creditors with nothing. At the center of this empire was Sam Bankman-Fried. To the public and to investors, he was an eccentric founder who slept on beanbag chairs and played video games during venture capital pitch meetings. By early 2022, his exchange, FTX, commanded a $32 billion valuation. It processed billions in daily trades for over 9 million active customers, projecting an aura of absolute stability in a notoriously volatile industry. That stability was reinforced by high-profile partnerships. Megastars like Tom Brady and Gisele Bündchen took equity stakes and served as brand ambassadors, convincing retail investors that FTX was a safe place to park their cash. The company poured money into the real world, securing naming rights for massive sports stadiums and lobbying politicians. They positioned themselves as the responsible adults in the room. On the morning of November 6th, the operation looked flawless, but a 120-hour countdown to total bankruptcy had already started. Behind the celebrity endorsements and the sports arenas, there was no regulatory oversight. The entire structure was an illusion, masking a massive financial shortfall. The collapse began with a single leaked document. A private balance sheet belonging to a cryptocurrency trading firm called Alameda Research made its way to the press. Alameda was founded by Bankman-Fried and later run by his on-again, off-again girlfriend, Caroline Ellison. It operated as a sister company to the FTX exchange, making highly aggressive trades. The leaked balance sheet revealed a critical flaw. Alameda's multi-billion-dollar foundation relied on FTT, a digital token invented and controlled by FTX itself, rather than traditional government-issued currency like the US dollar. The two companies were physically wired together. The exchange's director of engineering, Nishad Singh, wrote a specific piece of software to connect them. When customers deposited cash into FTX, Singh's code created a backdoor, secretly draining funds directly into Alameda Research accounts. Alameda then spent that stolen cash to cover massive trading losses, purchase Bahamian luxury real estate, and make tens of millions in political donations. There was no algorithmic trading failure here. The executives simply took billions of dollars that did not belong to them and spent it. To understand why they did this, you have to look at the philosophy driving the leadership team. They were adherents of effective altruism, specifically a branch called earning to give, the idea that you should maximize your wealth by any means necessary so you can donate it to save humanity. Bankman-Fried used this utilitarian calculus, the belief that actions are right if they benefit the majority, to rationalize his behavior. He convinced himself that illegally gambling with customer deposits was acceptable because the potential payout would eventually fund righteous causes. But philosophy does not pay out withdrawals. By day 3 and 4 of the crisis, the broader market realized that Alameda's balance sheet was largely worthless, and panic set in. As fear spread, millions demanded their deposits back, creating an exponential spike in withdrawal requests against an emptied vault. This digital contagion formula demonstrates that, in centralized digital finance, when trust in one token collapses, panic instantly infects every connected institution. Because the funds had already been siphoned off to Alameda, FTX could not fulfill the withdrawal requests. They were short by $8 billion. The leadership team's reliance on a perceived moral high ground blinded them to basic risk management, driving the company straight into the most devastating bank run in crypto history in a matter of hours. Exactly 120 hours after the crisis began, the timeline ran out. On November 11th, Bankman-Fried stepped down, and FTX filed for Chapter 11 bankruptcy, a legal process that allows a business to reorganize its debts while protected from creditors. The authorities moved quickly. Bankman-Fried was arrested in the Bahamas, extradited to the United States, and eventually convicted by a federal jury on multiple counts of wire fraud and money laundering. Both Ellison and Singh pled guilty and cooperated with prosecutors. Meanwhile, retail investors lost billions, and the effective altruism movement suffered a severe blow to its credibility, losing millions in promised funding. The damage extended far beyond one company. The collapse wiped out trust across the entire digital asset space, tanking prices and bankrupting several other major crypto lenders who had exposure to FTX. This catastrophe forced the government to act, aggressively closing the door on the unregulated frontier era of digital finance. Agencies like the SEC, which oversees securities markets, and the CFTC, which regulates derivatives, launched aggressive enforcement campaigns. Today, every statement and lawsuit from these regulators directly dictates trading volumes and market prices. Definitive